South Africa's growth outlook has dimmed. Earlier this year, the IMF slashed its forecast for 2024 and 2025, citing the negative effects of rail and port constraints. The fund's now trimmed that 2024 figure with growth pegged at just 0.9%. Its outlook for next year has been maintained at 1.2%, and while the IMF only sees a slim chance of a hard landing for the global economy, it has warned of a gradual erosion in global growth prospects over the medium to longer term. The total area debt owed by municipalities to Eskom has ballooned to close to 75 billion rand. This is well above previous estimates and comes despite interventions from Treasury. Municipal areas have more than doubled since 2021, with 135 municipalities having overdue debt. Volkswagen is growing its offering in South Africa. The automaker is set to add a new car at its Karega assembly line in the Eastern Cape and will invest 4 billion rand to make that happen. The car, which is a small sports utility vehicle developed in Brazil, will be built at Karega from 2027. MD Martina Biena says most of the funds will be spent on production facilities, local content tooling and quality assurance. The first phase of the upgrade will take place at the end of the year. Purple Group is back in the black. The Financial Services and Technology Group has posted an interim profit of 10.9 million rand. That's from a loss of 10.6 million rand previously. During the period, the firm managed to increase revenue by 29% and decrease operating expenses. CEO Charles Savage has described the set of numbers as exceptional half-year results. 91 says its assets under management came under pressure in its fourth quarter. For the 3 months to end March, AUM came in at 126 billion pounds. That's 2.5% lower than in the same period a year ago. South Africa's biggest asset manager will release annual results on the 5th of June. Afrimat has forecast a profit bump. The mid-tier mining and materials company expects full-year earnings to rise as much as 25%. The firm gave no reason for the increase, but full details will be provided when the company opens its books on the 15th of May. Further afield, U.S. retail sales rose more than anticipated in March, driven by a notable increase in sales at online retailers. This development adds to the growing evidence that the economy finished the first quarter on a strong footing. Let's take a look at this report for more.
U.S. consumers continue to defy expectations. A Commerce Department report showed retail sales rose 0.7% in March, blowing past economists' estimate of 0.3%. Data for February was also revised higher to show sales rebounding 0.9% instead of the previously reported 0.6%. Robust job gains have helped power spending, even in the face of higher prices and borrowing costs. That's confounded predictions of distress among consumers, especially those in lower-income households. The latest Bank of America credit card data showed lower-income spending continues to outpace that of higher earners, boosting sales, online purchases, and gas station receipts. Sales at bars and restaurants, the only services component in the report, also rose. Economists view dining out as a key indicator of household finances. But there were some pockets of weakness. Receipts at car dealers fell, as well as at furniture stores, likely as higher mortgage rates constrain home purchases. Sales at sporting goods, hobby, and bookstores also dropped, suggesting that households continue to focus on essentials and are cutting back on discretionary spending. The robust report prompted economists at Morgan Stanley to peg their first quarter GDP estimate at a 2.7% annualized rate, up from a 2.4% pace. It also bolstered expectations that the Federal Reserve could delay cutting interest rates until September.
Over in Asia, China's economy grew stronger than expected at the start of this year, expanding 5.3% thanks to robust growth in high-tech manufacturing. Here's more detail in this package report.
China's economy is doing better than expected. Figures out Tuesday showed growth hitting 5.3% in the first quarter. That was comfortably ahead of analyst forecasts. The world's second-largest economy has struggled to deliver a strong post-COVID recovery. It's been held back by factors including a mounting crisis in its huge property sector. Many major developers are struggling to survive as they grapple with massive debts. China also faces mountainous debts at local government level and weak consumer demand. Officials have turned to spending on infrastructure to help lift growth. The overall picture remains very mixed. Other data released Tuesday showed retail spending growing less than expected. Consumer price inflation also cooled more than expected, adding to signs of subdued demand from shoppers. For now, though, the GDP numbers will spell relief for officials, who have set a 5% growth target for the year. They're expected to unveil more monetary and fiscal measures in a bid to hit that figure. Many economists say it looks ambitious, however, with last year's rate of 5.2% flattered by a rebound from lockdowns.